Stanley Black Decker had a horrible quarter, and they're having a horrible year. As you can see, earnings have fallen about 47%. When I plot monthly closing stock prices on this graph, you can see that stock price has also fallen dramatically. The question is this now become a value trap, or is this an incredible opportunity to invest in this dividend king that has raised our dividends for 55 consecutive years? A very admirable track record. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Recently I did a write-up on Stanley Black Decker and indicating how, and this was just prior to the earnings coming out by the way, indicating that the stock had been really overvalued and it was now coming into fair value. And things have actually changed quite a bit since I did that early report. And I'll put a link to that video here in this particular video. But the point is, instead of earning a much higher number, their earnings came in very disappointing, and the stock price reacted to that dramatically, as I showed in the introduction. So let's analyze it from a standpoint of, do we now have a value trap? Is this now a good time to be buying Stanley Black Decker, or should you avoid it at all costs? Now, I'm going to ultimately let you make those decisions for yourselves, but I am going to give you my perspective and where I'm at with the stock. I have a small position in this stock now. The question is, will I be adding to that position now that the stock has fallen so dramatically? One thing I will point out, I would not sell the stock at these levels. I don't believe in selling something for less than it's worth, and I don't think you make money by buying high and selling low. I think you make your money ultimately on the buy side. It's how you buy the stock. So the question is, does this now become a buy, sell, or a hold? And I'll cover that in this video. But let's go ahead and now look at the fast graph chart on the stock, and let's analyze what I see here. Number one is I'm going back to 2002, and you can see that this is a semi-cyclical company, but really more of a consistent growth stock. And it's had some really attractive growth numbers over the years. Now, during the recession of 2008-9, you can see they had 2 consecutive years of down earnings. All right, now, then earnings recovered very strongly after that. Now, that's important in what I'm about to talk to, in this video. Then they had another down year just following that. And then they strung together some pretty good years. And I do want you to focus especially on 2019 here, where, this is a very important milestone for the company, because 2019 levels are something that the company's talking about as far as their company performing in the future at those levels. And I'll cover that in a little more detail. So when I put price on the graph, you can see that price generally followed that. Now, there were times when the stock was overvalued and the price got real low. And then there were times when the stock price, with all the volatility that normally goes along with stock prices, it tracked earnings very carefully. During the recession, it overreacted, and the stock price overreacted and fell much more than the actual earnings did, which was a really great opportunity to invest for a long period of time in Stanley Black Decker. Now, we had another opportunity to invest in this stock during the COVID, what I call flash crash. You can see that the stock fell dramatically and became one of the best buying opportunities on this graph. As the market likes to do, and you can see that they've done it several times in the past with this company. Remember, it's a dividend aristocrat. It's A-rated. The company's increased their dividend for 55 consecutive years. And they generate very good cash flows, and they've always generated very good free cash flow, but they did falter this year on the free cash flow, which I'll also cover here in a moment. But the question is the stock a buy now, a hold, or a sell? Well, I think it's something that, I'm personally looking at buying into. Now, the last I checked, the stock was still, having some downward pressure put on it. In today's kind of up market, it was down about 0.44%, which is not really that bad. It might be, nearing the end of the big drop off here. The question is, and I say this all the time in past articles, you can learn a great deal from the past, but you can only invest in the future. Now, the question is, I've got some estimates here, and I'm going to go through the estimates with you in kind of great detail here, as well as go through some of the other earnings transcripts and some of the messages from management here, the investor presentation. But the point is, earnings are expected to recover, and they're expected to recover, close to the 2019 level. That's what management is currently talking about. They should be functioning at that level because, a lot of companies are having supply chain pressures right now, inventory pressures. They closed their Russian operation due to the Russian war. So there's a confluence of factors here that have caused, this company to have some poor numbers. But one thing about this stock is I think it has a very good management team. The company's committed to paying their dividend and committed to generating shareholder value through share buybacks as well, which they've also announced a very strong share buyback. Now, if all that is true, then the possibility of the earnings recovery here is quite high. But I also want to point out the stock was also very overvalued, just as early as May of 2021. It was trading at, a PE in the 20s. It's now trading at a blended PE ratio of about 12, but that's on obviously very depressed earnings. The future earnings and earnings yield look much better. And the question is, how low is low? Is the stock falling as far as it's going to fall? My argument would be it's probably pretty close to that. I don't think there's a whole lot of downside in the stock at these levels. But, that's one of the key points here. Why would I now be attracted to buying the stock? Well, it is a dividend king. It's the kind of company that you can buy and hold for the long run, which is my goal as an investor in dividend growth stocks. I like to own them. As Warren Buffett said, the best holding period is forever. And that's my attitude. I want to position myself as a shareholder owner. Is management going to be able to fix this thing is really the ultimate question. And we'll look at that a little bit here in the future. But I want to go through some forecasting with you now. And I've gone to the FastGraphs custom calculator and I've input some data here. The company's expecting to earn between $5 and $6 a share now, adjusted operating earnings in 2022. Standard & Poor's estimates, their analysts estimate $5.68. That would indicate that the stock, could be worth, by year end, $83 a share, and that would be down from 94, down $10 or $11. That type of downside, I think, does possibly exist. But on the other hand, earnings are expected to be $8.73 for 2023 and then $10.72 for 2024. And that's as far out as I want to look. So I'd be looking out here to the next couple of years and the stock, recovering, and that could give me really strong double-digit rates of return. And I do expect modest dividend increases. The last dividend increase was about 3%. Okay, so that's obviously, not a real great number. But if you look at the company's history, their dividend growth rates have been 4% and 5% and even as low as 3% at times. And then that would be followed up with some 20% numbers and some close to double-digit numbers in the past. So this company does have a strong commitment to dividends, and management has all but said that. And they're very proud of their streak of 55 consecutive years. So obviously this is a distressed situation now. As I've often said, you don't find value without a reason. The question is this a permanent impairment of capital or is this a temporary interruption in a very strong business? I think personally it's the latter. And so for my own use, I'm willing to commit more money to this stock, but maybe not necessarily today, but soon. I'm going to be watching it to see how the stock reacts relative to the news and see if any additional news unfolds. But let's go ahead and go into the second quarter presentation that the company just did. And these were the participants: Don Allen, who's the president and CEO, Corbin Wahlberger, vice president, interim CFO, and then Dennis Lang, investor relations, which they're always there for these meetings. So here were some of the key messages of management that I think were very important. Now, first of all, everything wasn't all bad. They delivered $4.4 billion of revenue, which was up 16% versus the prior year. And it was driven by their strategic outdoor power equipment acquisitions and 7% price realization. Okay, they've been able to increase pricing. The company is implementing a global cost reduction program to deliver annualized pre-tax savings of $1 billion by the end of 23, and their goal is to do approximately $2 billion in savings within the next 3 years. That could help their margins, which were impacted pretty strongly in this quarter. They also just recently completed the sale of their security divestitures, generating $4.1 billion in cash proceeds, which strengthened their balance sheet and fueled capital allocation priorities, which are basically dividend income and share buybacks. I think that's very important. They updated their earnings guidance to $5 to $6, and that was from around $9 to $10 a share. So that's quite a drop in earnings. They think second half free cash flow, excluding taxes, is expected to be about $1 to $1.5 billion. And that's including tax payments associated with the security sale. So that includes that. They're intensifying their focus on operational efficiency. They're planning on aligning the organization and operating model around streamlined portfolio. So that's why some of these divestitures have happened to unlock the runway. They've also selling their oil and gas division, which is a small division. That's supposed to close in the third quarter. They'll take some impairment charges for that. I haven't actually seen all the numbers. That really hasn't been disclosed or announced, but that's something I'll be watching very closely over the next weeks and months. They're supposed to do that in the third quarter of this year, which is going to be happening reasonably soon if that's true. Now, there was some real headwinds that the company faced, and, they talk about that. I'm going to kind of skip through this now and talk about, what the company's doing to advance their core business. They've made acquisitions to strengthen their portfolio. They have a lot of innovation, a lot of products in the pipeline. They're rethinking their supply chain transition, trying to get closer to their customers and what they believe is better, serve their customers. They have this global cost reduction plan that, again, they expect to deliver $2 billion within 3 years. So the point is, without getting in all the gory details here and belaboring the point, management is taking action. They're doing things to reposition themselves. They believe their supply chain transformation can deliver $1.5 billion of savings within 3 years. And then they outline where they expect those savings to come from in the presentation. So, I would highly suggest that you go through this presentation if you're interested in this company and look at it. Their 2022 guidance is obviously weakened dramatically. They're looking at earnings that I've already mentioned of $5 to $6. We've got $5.56 on the graph I showed you. Their diluted GAAP earnings they expect to be somewhere between 80 cents and $2.50, and adjusted earnings to between $5 and $6. The reason there's a big difference there is they've got a lot of non-recurring charge-offs and non-cash charge-offs from some of these acquisitions and divestitures that they've made. And, they've got these charges of $760 to $810 million. They do plan on buying back shares, and they do still expect to generate free cash flow, but their free cash flow has faltered. So all in all, the company believes that, the actions they're taking is going to create a more focused company that has really strong franchises. They're reducing their organizational complexity and hopefully trying to generate speed and agility in the running of their business. And then they're reinvesting in their core businesses. So, I think that's all, relatively good stuff that management's doing. Now, you can also go in to the company's website and read their transcript for their earnings transcript. It's really quite long. I'm not going to bore you with details, but there are a lot of, powerful things the company pointed out. Now, I've gone into other research services and doing it, and, I've looked at Zacks here, and Zacks has, reasons to buy. They say they're poised to benefit from the strength in industrial business, owing to strong backlogs and healthy demand for aerospace fasteners. And they give a lot of other reasons here, but they do say this is something that I think was very important. Stanley Black Decker is committed to rewarding its shareholders through dividend payments and share buybacks. That's really a key. The company is quite proud of their 50-plus year record of increasing dividends, and they plan to, continue to do that. Another thing I like about Zacks, they do point out some of the issues. There's reduced retail and consumer demand are weighing on the tool and outdoor segment's performance. That's their big segment. They have operations in multiple nations, and there's obviously been some currency headwinds as a result. And their balance sheet has weakened pretty much as a result of this last earnings report, but they're taking a lot of measures to strengthen that. So, there's a lot of other issues on the company. I'm not going to belabor all those, but, the company is, reiterating their outlook that I've already described several times. So looking at the company, there are reasons for the stock price to be down. I do want to again emphasize that overvaluation is usually always a part of that. When stocks are highly valued like Stanley Black Decker was just in April and May of last year, of 2021, they become very vulnerable to any bad news. And of course, there's been a strong reaction to that and the price is down. But the key is you make money on your buy side, as I've already said. And like Warren Buffett, advised us, you want to be greedy when others are fearful. The question is, can you be greedy now when the whole market is fearful because of a bad quarter? And the real question that needs to be asked and answered is, are we looking at a temporary interruption in a great business, or are we looking at a permanent impairment of capital? If this company does get back to their historical 2019 earnings levels, that would make the stock price look really undervalued today. And then if they grow above that at double-digit rates, which the company believes and management believes they're going to be capable of doing, then, the stock would be very inexpensive here if you have a time frame of 2, 3, 4, 5 years out. This is not going to be immediate gratification, although it could be. When the stock gets beat up this badly, the recoveries can be quite strong. COVID did not generate the poor operating performance like we're seeing now, but you can see how quickly the stock did recover from the COVID lows. So that's something to think of. We are in a recession. We're not really marking that yet on the fast graph. That recession is going to affect not just Stanley Black Decker, but a lot of companies. So there will be a transitional period here that, the company has to get through. And again, management, talked about that in their recent reports and, and they're emphasizing what their strategies are and what they plan on doing. So I would, go ahead and look at this, very closely, look into what the management's plans are and see if you feel comfortable yourselves, whether or not, management can pull it off. I do want to make a point. They do plan to grow organically about 4%. And maybe through acquisitions by another 8 to maybe 10 or 12%. And you can see here, this is a Wikipedia report that just simply talks about all the acquisitions the company's made. They've really grown their business by making acquisitions, but they've also done some divestitures. So, the company is not just forecasting what their current business is going to be. They're also looking to, add additional businesses and additional opportunities for growth into their core business. So all in all, Stanley Black Decker is really a high-quality company. It's definitely got some issues right now, from a standpoint of their operating cash flow, which, really secures the dividend. Even though they've had a big drop in operating cash flow along with earnings, it's still covering the dividend. As I did mention, free cash flow is currently not covering the dividend due to the normal free cash flow. It's currently not covering the dividend, but is expected to recover strongly. So if we were looking at valuations based on, free cash flow, there's a lot of upside, left in this company. The revenue side has been one of the brighter spots. It hasn't been anywhere near as, bad as the other side, but they have had some problem with their margins, as I mentioned. They're trying to do everything they can to get their margins back into, more competitive levels in the industry. If you're a subscriber to FastGraphs, I would suggest you go into, the fund graphs and look through, some of their financials. But keep in mind, you're looking at mostly history there. The real key is, what does the future look like for this company? And I believe the company still has a long and bright future ahead of it. I think they have a great management team. I think the company has been very good stewards of investor capital. And my bet would be, I like the company going forward. And this is, really just an opportunity to acquire a really high quality dividend champion and king, a company that's increased their dividend for over 5 decades and going on 6, and is still committed to continuing that streak and continuing to do that. And I believe the company will have the resources and it has the strength of their balance sheet and the strength of their assets to do that going forward. So it takes a little courage to be an investor here, but I like my chances. I'm probably going to be adding to Stanley Black Decker, but I'm going to give it some time here to, just see how everything settles out. Anyway, this has been Chuck Carnevale giving you an update on Stanley Black Decker. Hope you enjoyed the video. If you did, ring the bell, subscribe to the channel, give me a like, obviously, to see how powerful the FastGraph tool is and how it can really help you make better decisions. So you might want to take a look at subscribing to it as well. I've been showing you the new version of FastGraphs, which we intend to launch here relatively soon. So anyway, it's been Chuck Carnevale saying thanks for watching, and I look forward to talking to you real soon. My next videos, I'm going to start looking at some dividend growth stocks for total rate of return. I've been focusing on the high yield And the high yield is typically the low growth part of the marketplace, the dividend growth marketplace. Companies usually generate high yield because they don't have a lot of growth. I'm going to get into lower yielding but much faster growing stocks in my next videos. Thanks for watching.